a quick review and recap. I'm very much hopeful that we still understood how we got to where we are. We are looking at this particular question, and I'm impressed that I've seen some people asking questions and the likes. Uh, One thing I can tell you is this. This will be the part 2 of the class of yesterday. But one thing I can tell you is any question that comes from group account should be a bonus to you. You're able to deal with it and avoid as quickly as you can. So we're actually looking at this question. Daddy PLC, a first tier entity coded on the Nigerian Stock Exchange and the likes. Then we have 3 different purchase consideration in this question. Share for share, loan notes, as well as cash payment. And then at the date of acquisition, we're told that the market share of Daddy PLC is 75 kobo. Now, the essence of why they give us this 75 kobo is so that you will know that when you have done your adjustment for the share for share, and you know the number and the quantity of share that was bought, for you to get the value, you multiply by this the market price of the share of the parent company. That's why they gave you that. The cost incurred by banks, okay, this one we have read it, is assumed to be nil. Also, that the PSC recorded a 12% loan notes and the likes. I'm just doing a recap on the question. I'm sure you have the questions. This is it. We are now also required. We are asked to prepare. Where is required? Required to prepare consolidated statement of financial position as of December 31st, 2020. And I remember that I told you that whenever you are dealing with a group account, once they ask you to prepare a consolidation of financial position, there are 2 steps that are involved. Who can quickly tell me those 2 steps? All right, go ahead, Damala.
Step 1, you open the skeleton, and for the step 2, you add body to the skeleton by doing the 7 workings.
Thank you so much. So that is that for that. Those are the 2 main steps that you need. Open up the skeleton. And then the second one, we will do what we call adding body to the skeleton by doing 7 workings. Yes. So who can tell me the first 3 of the 7 workings? Maureen.
Function.
Yes, sir.
Consideration.
Solani, please hold on. Mute your mic. Maureen, go ahead.
The first working is that you determine the years in the consolidation.
Okay.
And then after determining the years, we determine the group structure.
Okay.
After determining the group structure, the working 3 is determination of net of the subsidiary. And then working 4, determination of goodwill. And we say goodwill, we have 2 methods of solving your goodwill. That is the full or fair value method and the proportional method. And then the working 5 is determination of group retained earnings.
Okay.
And then 6, determination of NCI. And then the last one is the adjustment.
Thank you so much. So I think I don't have any worries again. All my students, they are going to pass FR, and that is very, very impressive of you guys. Thank you so much. So let's continue briefly. We have been able to open the skeleton, like I told you. This is how to open the skeleton. We did that yesterday. It is first of all by writing down the name of the group, Daddy PLC Consolidation of Financial Position for the year ended at the 1st December, and then write the notes, the rounding off figure, as well as the currency that is involved. And then you open up the skeleton by, first of all, writing all of those items, combining like items together, under the assets as well as the liability. But for the equity, you write equity. The next thing that will write equity, you carry only the parent's equity, dump it there. Next thing that you are going to write on the equity will be the group reserve. We just open bracket, write workings, leave it. Then you write your NCI. Then go to liability, add all the like items in the liability, and that is that for that. You are open up the bracket. If that is all that you know how to do, give it to them, close your book, and then walk away. That's how to open the skeleton. But if you can go further, as time will permit, go and do what we call adding body to the skeleton. And I told you by doing 7 minimum workings. And then we have workings 1 to be that you are going to determine the consolidation, the years in consolidation. Very, very important, which is what we have done here in our workings 1. That's steps 2, determination of the year in consolidation. And in this particular question, we have the date of execution of the 1st of January, and the date of consolidation or the reporting date will be December 31st, 2020. The years in consolidation is just 1 year. And I said, workings 2, determination of this group structure. We had to do some workings for us to get the 80%. We were told that this PLC acquires 640 billion share in Mommy's PLC. And so they told us that in the body of the question that the value of Mommy PLC is 200 billion naira, and each of Mommy's PLC is being sold for 25 kobo. And so for us to determine the total number of shares that Mommy PLC had, I've always told you, whatsoever they give you in value, just carry that value as your numerator, and then the price per share will be the denominator. Any day, any time to give you the numbers of shares. You need this, what I've just said now, you need it also when we are doing our ratio. When we are to determine earnings per share, EPS, you need to know how to determine numbers of shares. So it's important for you to note what I've just said right now. And please let it stick to you. And that's what we just did. Number of shares, the value of shares in Mommy PLC was 200 billion naira. And we're told that each of them is 2.5, that is 25 kobo per share. When you divide 200 by 0.25 kobo, it will give you 800 billion total number of shares. And so since that PLC acquires 640 billion of share in Mommy, to now be 640 divided by 800, that gives us 80%. Please take note of what I just said. And I said working theory for us to determine the fair value of the net assets of subsidiary or NCI at acquisition, the reporting date, and the likes. And so ordinary share 200, and I told you whatever the ordinary share is at acquisition day will remain the same thing as reporting date, except if there are issues, and it will be well detailed and well stated. So you can have ordinary share, which is share capital. You can as well have share premium. Please take note. Whatever you have under the equity structure, whenever you are doing your workings, that is what you are going to bring to bear when you are doing your workings 3. We have just 2 items there under the equity, and that's we have ordinary share and then retained earning for the subsidiary, and that's what we have just considered. Also, another item that will come under workings 3 will always be any fair value increase, as it were, of PPE, as well as its depreciation. It's going to come under workings 3. There are other items that will come, and you will note that. You will note them as they come. For instance, impairment, assuming they told us that our impairment on the PPE from the date of acquisition to the date of consolidation, we are going to bring it to bear in this particular place. We remove it from the asset as well as we take it to our profit or loss, as it were. And that's what we are going to consider under the group reserve, because it is an impairment. Please take note of that. Are we still together? I'm sure we are. So the next working was workings 4, which is determination of our goodwill. And from the question, we were told that we are to use the full or fair value method. And I told you, once you see use full or fair value method, always note that there will always be what we call a fair value on the net asset of the subsidiary at acquisition date, net value of NCI at acquisition date. Usually it used to be in the question, but in case you did not see it, don't worry. But just know that for you to determine depreciation, whether using proportionate or full goodwill, is also to be purchase consideration less net asset of NCI. Now, the net asset that you are going to carry will be determined by the type of method that you are asked to use. If they ask you to use full method, it means you are going to less the total net asset of NCI at acquisition. But if they ask you to use proportionate, it means that you are going to less the parent's portion of the NCI at acquisition. That is the only two difference. Let me take it again. Goodwill is being determined by, removing from purchase consideration the net asset of the subsidiary that is acquired. Now, what will determine the kind of net asset as acquisition that you are going to less is in the type of method that you are asked to use. That is to say, you have two methods. You can decide to use the full, or you can decide to use the proportionate method. If you are using the full goodwill method, it means that you are going to carry the total net asset at acquisition and less it from the purchase consideration. And then also, if you are using the proportionate method, you are only going to remove that of the parent's portion, and then you are going to divide it. You are going to less it from the purchase consideration. However, please note that when you are doing what we call proportionate, when you are using the proportionate method, whatsoever post-acquisition loss, you are going to share it between the parent and the subsidiary in their proportionate percentage. For instance, we have impairment in this particular question of, I think, 30 billion or so. Assuming we are using proportionate, the whole of the 30 will not come to the parent. The parent will not be the one to bear it in consolidation. We are going to rather divide it between the parent and the subsidiary using their proportionate equity percentage. You understand that? I'm sure you do. And if were to be any other losses, as it were, they're going to share it. The post-acquisition, normally, any day, anytime, whether there is loss or whether we are using proportionate or not, they are still going to share whatever we have under the post-acquisition, because the post-acquisition, whether there is profit or loss, all will not go to the parent company alone. Please take note of that. So that's where we stopped, I believe, yesterday. We're able to determine our goodwill. Oh, you did not give me the value for goodwill. What do we have as our goodwill?
196.
Okay, 196. All right. Also, yesterday we were able to determine, or the last slide, let me say, determine the purchase consideration, and we have 3 considerations. We have share for share. This one I said share for share 2 because it also has to do with getting the loan to purchase the share. You can also call it loan consideration. Any other language that you call it, or just put down the name that comes to your mind. Thank you. So we have cash consideration also, and the total consideration was 496. So now let's go to workings. Workings, I think 5 now. Workings 5, and that will be what determination of the group reserve. Determination of group reserve. So when you are determining the group reserve, the first thing first is you are going to bring in the retained earnings of the parent.
Excuse me, sir.
Go ahead.
That share for share, can it be also be named as a share exchange consideration?
It's the same thing. Share for share, exchange. Exchange means share for share or share exchange. Exchange, something is exchanging for another thing.
Okay, sir. Thank you.
So you have retained earnings. Please always note only parent. The parent earning, retained earnings, that's what we are bringing here already. We have adjusted for the retained earnings of the subsidiary in workings 3, so you don't need to do it again under workings 5. So what is the retained earning for parent? Are we together? Are we still together?
Yes.
So what is the retained earning for the parent?
Retain earning for the beginning, that is 220 for the 1st of January 2020.
1st of January 2020. Now, since you have 1st and 31st, the one that you are going to carry for parent here is the net. Or let me check. What do they have as a closing? Okay. You just carry, sorry, please. Carry the net, retain earning at opening and the closing. That is what you will carry, just like you are doing at acquisition and at consolidation. So carry the net. Please take note of that. So parents only, and that is equals to, what's the opening? 220 minus, okay. Is it 100 or 120?
100.
100. Okay. Now, the income statement, did they give us income statement in this question? Check. Okay, there's no income statement. Is there any other additional information on the retained earnings? Let's be sure. Okay, that is that for that. So we have what now? 120. Now, there was, okay, now we have to go and also do workings 6 now. Okay, leave working 6 here. Then let's go to working 7. Working 7. Let's determine the unrealized profit. Working 6 is determination of the determination of NCI. Now working 7 now, let's determine or eliminate the intra-group unrealized profit, as it were. Working 7, that's where we begin all the other adjustments, as it were. Adjustments. So you have 1, determination of unrealized profits. Now, we were told in that question, let's go and check that question, that Omni PLC, let's go back. Okay. Additional information 4. Mobi PLC sold goods worth 20 billion to Daddy PLC during the post-acquisition period. And then 5 billion of these goods were included in the inventory of Daddy's PLC as at the 1st of December 2020. Now, all of these stories, they do not concern you. All that you need to just note in all is, were there any unrealized profit? If there is any unrealized profit, then that is the only thing that you are going to consider. And from here, we were told that one PLC made a profit of 8 billion naira. So therefore, we have to determine the margin. It is the margin that we will now use to note exactly if there were unrealized profit. And how will you do this? We were told that the goods that were sold was 20 billion. And then on the 20 billion, there is a margin, a profit margin that was made, 8 billion. So without 8 billion now, we are going to know, sorry, please. So first step is, first step here is to determine the margin. Determining the margin, which is equals to, we were told that the good that was sold was 20 billion, if I can still remember, yes. And then the profit is, what is it called? The profit is, how much is the profit, please?
5
8
billion.
billion.
8 billion. So if it is 8 billion, now let me, for the sake of those that may not know how to do all of this, in determining unrealized profits, the first step is for you to always determine the margin. And for you to determine the margin, you need 2 key items. The first item is what exactly is the total number of stock that was sold to the parent. Now, parent can sell to subsidiary. Subsidiary can also send to parent. You understand it now? Parent can sell to subsidiary. Subsidiary can as well sell to parent. Please take note of that. Take note of what I have just sent.
Excuse me, sir. Hello, sir.
Go ahead, please.
Sorry, sir. Like in a situation whereby a parent is the one that is selling to a subsidiary, sir,
Yes.
are we still going to treat it on this in NCI also, and also and effect it also in group retain any
You, you,
working,
didn't,
sir?
you didn't allow me to finish up. I will have finished up before you ask. Now, when parent is the one that sells to subsidiary, any unrealized profit will go to NCI. But if it is a subsidiary that sells to parent, any unrealized profit will go to the group reserve, which is the workings 5. Please take note of what I've just said. Parent can sell to subsidiary. Subsidiary can also sell to parent. But when it is parent that sells to subsidiary, any unrealized profit will go to where? The subsidiary, which is the NCI, non-controlling interest entity. But if it is the, what is it called now? The subsidiary that sells to parent, any unrealized profit will go to the group reserve. You understand? Because it is the parent have not what is it called now? Fully make available the profit margin that have already been marked. That's why if it is a subsidiary set of parent and there is any realized profit, you charge it to the group reserve. But if it were to be the parent that sells to the subsidiary, you charge the, what is it called? You charge the unrealized profit to the NCI. Is that taken? I'm sure you understand it now. Now, I said in determining unrealized profit.
Hello, sir.
Go ahead.
Hello, sir. Oh, sorry. I just want to get the clarity of what you just said now, because to my own understanding is that whenever the parent, whenever the subsidiary sells to the parent, that is when the parent and the NCI will have the portion of that profit to be shared. I mean by reverse. But whenever it is parent selling to the subsidiary, because it is only that parent that will adjust for the unrealized profit.
Well, me, I'm telling you what is obtainable and what is in the standard. When parents sells to subsidiary, every unrealized profit is taken to the NCI. When subsidiary is the one that sells to parents, any unrealized profit is appropriated under the group reserve. That is the group retained earning. Now, maybe.
Sorry.
Oh yeah, I'm listening now. I want to teach you.
Sorry, I don't get it too. Because I was thinking that any unrealized profit, if the parent is the one selling, it will be deducted from the retained earnings or the group retained earnings.
That is it now. That is the posting.
Okay.
It will be deducted from the group retained earning if it is the subsidiary that is selling to parent. And if it is the other way around, it will also be deducted from NCI.
Okay. Thank you.
I will go ahead.
Well, maybe we don't understand. Maybe when you treat this one, maybe we understand you better, sir.
Oh,
Maybe
okay,
we don't understand your group and the NCI. Okay, sir.
Okay, let's go ahead. So first step I said when you are determining the margin is you need 2 key items. The first one is the total volume of goods that is sold, as well as the profit that is made. That is what you can use to determine your margin. You can as well be given the margin portion in your question. They will tell you the profit margin or the margin is 40% or 20% or whatever. You can be given, but in case it did not give you, this is how to determine it. Number one, look out for the total value of good that is being sold or that is in exchange between the parent and the subsidiary, and check out who is also doing the exchanging. And then look out for the profit margin that is being realized. So from this question, we were told that the value or volume of the value of goods sold equals to how much?
20 billion.
20 billion. And then the profit margin is how much?
8 billion.
8 billion. So this is the first step. Then the second step is divide profit margin by value of goods sold multiply by 100. This is 100% as a 12. Why I'm taking my time to tell you all of this is they may also give you a question whereby you will be the one to determine the value of goods sold. They may tell you that the total quantity of goods that has been transferred is 500 units of goods, or the total number of goods rather that is being sold to parent now is 500 units of good at 2 naira each. You'll be the one to determine the value. So the value of goods with this instance or this question I've made is going to be 500 multiplied by 2, and that will be equals to 1,000. And they will tell you that the profit margin is 20% of the total worth of goods. So you determine 20% of the total worth of goods, 20% of 1,000 is 200, and that is your profit, the profit value that you are going to get. So the second step is divide the profit margin by the value of goods, and that will be equals to 8 divided by 20 multiplied by 100, and that will be equals to what?
40%.
40%. Thank you. Please confirm or is it correct? And then step 3.
Sorry, I just joined. What question?
What we were doing yesterday.
Okay.
Then the third step will be equals to you now multiply this is your 40% by the 5 billion, which was the total value of goods that we were told that remains in the closing stock of the parent. So third step is multiply result of step 2, which is the profit, which is the margin rather. Step 2, multiply it by the unrealized inventory.
Sorry, sir. The total value of goods.
I'm not hearing you. Hello? You were saying something. Are we still together, please?
Yes, sir.
And that will now be 40%. 0.40 multiplied by how much is the worth of the goods that is remaining, that they say is remaining, that is closing inventory, the parent's closing inventory?
5 billion.
5 billion. Please confirm. What will you give to us, please?
2
2
million.
billion.
2
2
billion.
billion.
So this 2 billion, we take it to the group reserve. That's our workings 5. Unrealized profit. That is that for that. And quickly, I'm sure we can as well quickly determine our NCI before we check if there are any other adjustment we are bringing. Of course, there's an adjustment we are bringing under the group reserve. That's that is share of post-acquisition profits. Share of post-acquisition. That's post-consolidation now. It's consolidation profits. Is how much was their profit for yesterday? When we are checking it, how much was the profit they made post-acquisition profit? We have 25 here. This 25 was reporting date. This is all our considering. I'm sure you can see determination of the fair value of net assets of subsidiary at NCI. I mean, at acquisition reporting and post reporting or post consolidation date. This is the essence of why I said you should do it this way. Just go to your working series and let them know this is what you have done. And so we have 25 here. This 25 will be shared by both the parent and the subsidiary as a post-acquisition profit. So for both NCI and then the parent, they are going to share that profit. So post-consolidation profit. The group structure is 80%. So to now be 80 multiply 80% multiplied by what's that again? 25. Right? You can as well do it for NCI share of post consolidation profit. That will then be what will be the percentage you are going to use for the NCI?
20%.
20%. What's happening now? I hope we are getting this, we are getting more confused. Olafe, are you there?
Yes, I'm getting it, sir. Go ahead, sir.
Okay. 80% of 25 is what?
20.
20. Okay. 20% of 25 is what?
5.
5.
5. Okay. So now let's go and check all our workings. I mean all the additional informations and be sure we are dealt with all of them. Because those are where majorly the issues are. Number we have dealt with additional information. One we dealt with. It's 50 billion in excess of current amount with additional deposition of 5 billion in post acquisition. We dealt with this. Okay. The intangible assets was for a television of 30 billion in payment. I think we have dealt with this also. The third one is a group policy to value non-controlling interest. The fair value of NCI as a date of acquisition was 100. Okay. This fair value of NCI, we are going to also recognize under NCI. Please take note. Fair value of NCI. How much is it?
100.
Well, no answering me again. What's the problem?
100,
What's
sir.
okay? What will be the total?
105.
So it's 105. So it's also
Okay, so
always advisable that once you are done with any workings, post it immediately so you will not forget. Very, very advisable. Okay. Let's go and check. Then we were told that Mommy's PLC trade payables of 9 billion did not agree with Daddy's PLC's trade receivable as a result of cash in transit. Now, Olafẹ, you want to say something? Okay. Now,
no, sir,
this
it
is what.
was a mistake.
Okay. Please note this very clearly. This workings 5 is known as intragroup movement, intragroup balances. And then they should cancel out one another. They should cancel out one another. Assuming we were told that Mommy PSC trade payable is 9 billion. Mommy PSC trade payable of 9 billion did not agree with Daddy PSC's trade payables, and they put full stop there. Or you just ignore and go ahead, or you just make a statement. These are intragroup balances, and then they must cancel out one another. You understand? But they go ahead and tell us that as a result of cash in transit. Now, this cash in transit, you have to recognize it as a movement which is going to bank. You understand it now? In other words, this 5 billion that is cash in transit will now be what you will recognize as cash in transit under bank. You recognize 5 billion cash in transit, and that will increase the group bank balance that we have in the group. So please always understand that you have to eliminate in full every intra-group balances. Every intra-group balances must be eliminated. And then if there are any cash in transit, you add it to the group bank balance. This one, I don't feel we should just do any adjustment. All we just need to do is maybe just take off. Okay. Working 7. Please, I'm coming. You that raise your hand. Just hold on. Working 7. Other adjustment 2. Intra-group balances. Intra-group balances. So we have Daddy PSC trade receivable Mommy PSC trade payable balance equals 0. We cancel out one another. Notes. Intra-group balances is eliminated. The cash in transit will be adjusted for in the group bank balance. No, the cash in transit of 5 billion will be adjusted for in the group balance. So we go to the bank balance in our skeleton, the skeleton that was open, and then we put it there. That does it. Where is it? Okay, you can see it here, plus 5. Then you can close it. So now let's begin to close our books. There's only coming to intangible asset again. PPE is only again. Inventory. Okay. We have unrealized profits of how much, please? Our inventory now will also warehouse the unrealized profit. How much is it, please?
2 billion.
2 billion minus 2. Every unrealized, please take note, every unrealized profit, they have 2 implications. The first one is you are going to reduce it, from profit. And that is being done in the workings 5 and working 6, either of the two. Either it is being reduced from the group reserve or from the NCI, depending on who is selling, who sold to each other, either the parent or the subsidiary. That's the first leg. And the second leg will always be to the inventory. Please take note of that. And then also in eliminating the intragroup balances, please always also state it there. Please, this inventory now, we did the adjustment in working 7, I guess. Yes, working 7. Then also we were told that the payable and the receivables, they should be eliminated. So you have to also eliminate it, the 9 billion. The reason is simple. They are intragroup balances. You cannot hold yourself. You cannot hold yourself. Parent cannot hold subsidiary. Subsidiary cannot hold parent because they are now one flesh. Husband and wife, in real sense, they should not hold themselves because we were told that 1 + 1 is 1 when it comes to marriage. I don't know if you have any other opinion as regards that, but that is what we know. My husband cannot hold wife cannot hold husband, because the money that belongs to the husband is the same money that belongs to the wife. I'm sure all the female here will agree with me that I'm saying what is correct, right? Your husband money is your own money, Abi, and your wife's money is also your own money as the man, so you cannot hold yourself.
Sir, the women know they agree for that too, that their money is their husband's money. They don't agree to that, sir.
Okay, but I'm sure they've been hearing me now. They have agreed with us.
That's why now they succumb. Now that's why they didn't say anything, sir.
So you also less it from there. So you eliminated they cannot hold one another, minus 9 billion. So if the subsidiary is carrying in his book, and what is the question in his book, you eliminate it. You only recognize the cash in transit, because that cash in transit will mean that maybe a customer is still holding them and have not yet make the payment. And so you are expecting that that amount of money will come back to the group. You understand? All right. Ask a question. Olafe, you raise your hand.
Yes, sir. Regarding to this inventory, sir, I thought that 5 billion, we need to deduct the 5 billion from this account since it has been recorded in the subsidiary. The 5 billion of that inventory, the remaining balance of the inventory in the parent.
Please. So I don't understand where are you speaking from exactly now? Which one are you
No, sir.
speaking from, please?
The intergroup transfer of inventory of that 5 billion, the sales of inventory from subsidiary to the parent, that 5 billion balance in the book of the parent of that inventory.
Okay, let's go back to the additional information and be sure of what we are looking at, of what you are saying. Let's go and read the additional information. Information 4. Mommy PLC sold goods worth 20 billion to Daddy PLC during the post-acquisition period. 5 billion of these goods were included in the inventory of Daddy's PLC as at 31st December 2020. Mommy PLC made a profit of 8 billion on the sales. Now, what you are concerned about is not the amount of the worth or the value of the goods that is in the inventory, because you cannot tell me that the whole amount that is remaining in the inventory is going to be lost out at now, for instance, Mommy PLC did not make profit on those 5 billion. That's why you cannot carry the whole of the 5 billion and deduct it from their inventories. That's why we are doing adjustment to determine the unrealized profit, because certainly some level of profit will have been made on this inventory, the goods that are in the inventory from Mommy's PLC. We are concerned about that profit that will not be realized, because now we are consolidating them. You understand? Huh? We are bringing them as one. So you don't expect that the parent will pay that profit back to the what is it called now? Back to the subsidiary. Now, before you marry, let's do the husband and wife issue again, because that is the only thing you can easily put on your head. Before you marry your wife, let's assume you were a business partner. Your wife, she's owing you. Before you marry, your wife was owing you, and you now got married. Do you still expect to collect? You still expect to collect back the amount that your wife is owing you? No, certainly. The only thing there is the value of that good that is remaining. You need to note it, and then a portion of it that you know that the profit will not be realized. That is why we call it unrealized profit. The one that cannot come back, you have to remove it from the profit that have already been. You have already said, okay, this is the profit I'm going to make. So that's why we are removing from the retained earnings, as well as from the inventory, because we know that it is not going to come back. Is it clear now? Olafe, is it clear?
Sir, let me just go with you. But based on what you just explained and what I read, I thought, the 5 billion that is in the question, is it an additional information? Then number one, it has been taken note of at the subsidiary. It has been recorded in the subsidiary stock, and bringing it here now, since we cannot have intra transaction. So for us to have, for the 5 million to be in the subsidiary, and we've been reported in the parent, I think we need to reverse. Okay, we can just continue. Let's continue, sir.
Okay, now let's I understand the man. Let's look at it from this angle again. The subsidiary sold goods worth 20 billion to Daddy PLC during the post-acquisition period. During the post-acquisition period, that is after the parent have acquired the subsidiary. We now know that 5 billion naira of these goods were included in the inventory of Daddy PLC. In other words, 15 billion will have gone out. Is that not so? Because the goods that were sold, of course, what is it called? Daddy PLC will not be the one to hit that good. They are going to sell it to customer. But they have sold 15 billion, the remaining 5 billion. You understand? Now, we were now told that an additional information was not given to us that the goods, the 20 billion goods that was sold, 8 billion naira is the profit that was made on it. They made a profit of 8 billion naira. But remember that assuming that the PLC sold the 20 billion total, that is when we can realize 8 billion as the total profits. Do you understand it now? Assuming the whole of the 20 billion naira by Daddy PLC was sold out to the customer, that's why we can fully claim the 8 billion naira. But now, there is a worth of goods of 5 billion that is remaining. How can you note the total profit that is not going to come from this 5 billion? That's what we are saying now. How do you want to know the total profit that is not coming from the 5 billion, the one that cannot be realized? That is what we are looking at exactly here. You understand now? So there is no way you can tell me that the whole of the 5 billion now, which we expunge it from the inventory, how will you not know the exact amount that the profit is not will not be realized on it, that you not realize profit on the outstanding asset? Well, how will you know? That's why we have to determine what we call the margin. When you now determine the margin, you multiply by that balance, and it will tell you the portion that will not be realized. For instance, when we determine the margin, we got 40%, and 40% of the 5 billion gave us 2, meaning that out of this 5 billion, they have already realized 3 what is it called now? 3 billion, or let's say from 8 billion total on 20 billion. On this 5 billion now, if we have 2, it means that that's 20%. 80% have realized on the 5 billion, only remaining about 20%. You understand? That's the essence of determining the unrealized profit. And once you determine the unrealized profit, the one that will not come, you are going to take the value. It means that it's only the 2 billion from the 5 billion that is not coming back. So you can't take the whole of the 5 billion out of the closing inventory. I'm sure my explanation is clear enough. Okay. Any other question? No, there is none. So let's close up all of these. 650 plus 350 minus 5, what is it going to give us? Are we still together?
Hello, sir.
995.
Let's close up this thing and then we'll look at I'm coming.
Okay, sir.
So we have 10 here, right? Inventory is what?
1, 2, 3.
This one is what?
Trade receivable is 251.
251. The bank is what?
40.
Total.
1479.
1, 4.
1419.
Oh yeah, now you should tell me.
1419.
1419. What's our group reserve? Have we total our group reserve? What do we have? What do we have?
138.
What about this? Our NCI 105. Okay. NCI, what do we have?
105.
105.
Okay. Our 12% loan notes. I'll close it. 100. Payable is what? What's our payable?
201.
Okay. Other expenses?
60.
Current year tax?
80.
Overdraft? 30. What's the total?
571. Oh, no.
And it's 1164.
You are not balance?
1164.
1164. What do we have in assets?
Asset is 1419.
How come? You are not balance. 419. When I begin to see 419, I'm suspecting something might be wrong. What's the difference?
Two five five.
255. Okay.
Sir, we haven't considered the overdraft of 96 billion.
I'm coming.
The consideration.
Just hold on. There's
The
something.
overdraft.
You see, people did not. Which overdraft?
Consideration. The overdraft for consideration, for purchase consideration.
Okay.
We didn't include goodwill.
We did not include goodwill too, yes. Where is the consideration?
96 billion.
Oh. Sorry. So why is it an overdraft?
Sir, under the parents, according to the part of the considerations, they said we borrow the money to pay for the purchase consideration.
I'm coming, please. Hello. Okay, the meeting have started. Give me 2-3 minutes. I'll get back. I'll join you people now. Okay, thank you. Okay, where did you say you see television as a result in legislation consideration 30 billion impaired? Okay.
Option 3 of the consideration from the beginning of the question, that we borrow money from the bank to pay the consideration.
They issue 12% loan notes.
Yes.
No, no, wait now. Well,
The
let's go and check
cash payment.
They have
the cash payment of 15 kobo per share.
If you check.
Okay. Yes. Option 2. Issue of 1 naira 12 loan notes in Daddy's in exchange for every 400 shares in Mommy PLC.
So you are saying we should have recognized 196 under 12% loan notes?
96, yes. 96 at bank overdraft under the current liability.
No, it can't be overdraft. Overdraft is just 3 months now. Or let's say, yes, usually 1 year. But we're not told. So don't assume that, please. We did not recognize goodwill in this question. So let's go and recognize goodwill. Very, very important. Goodwill is always working to what?
Okay, it's 4.
What do we have?
196.
196. Okay. This is how to do consolidation of sale profit or loss. I assure you I will do the corrections and I will send it across to us on the WhatsApp platform. Of course, I've always told you guys, although I know that in this particular question, I changed some figures that might also be different from the past question that you had.
Unrealized profit too is excluded.
And the PPE of the fair value too, 50 billion. Under the PPE, that 50 billion that we adjusted for the net asset, we do not include it in the part of our PPE carried forward. The PPE fair value of that 50 billion that we adjusted for under the net value, under the net asset at the acquisition date.
We have already adjusted for it now to determine our net asset at acquisition. We considered it here now. Okay, you mean we consider the depreciation? We did not consider what it's.
No, sir. What I mean is that I know that this the net assets here.
I understand. It's supposed to be plus 350 minus 5. Let me just take my time, do this question. I will repost it to you guys. Is that okay?
All right, sir. No problem with that, sir.
Yes, sir.
Okay, sir. Thank you, sir.
Ask your question. I have a meeting now, please. So that let's just do the next 2 minutes and do a recap on ask your questions.
Okay, sir. Sir, quick one, sir. Under this contingent consideration, I just want you to help us to expatiate on this issue of fair value at the beginning and the fair value at the end of the year. when we are considering the contingent consideration, purchase consideration.
Now, when it is at the beginning of the year, if it's at the beginning of the year, you are going to, whether it is at the beginning or at the end, you just need to take cognizance of when the payment will be made, the period involved. You understand now? You have to take note of the period that is involved, because that is what you will discount into the present value. You understand me now? And if the payment will be made within 1 year, there is no need for you to discount it, because it will be made within that year. Now, if you check this question now, the consolidation period, the consolidation year is just 1 year, from beginning of the year to the end of the year. Assuming the acquisition date, assuming the consolidation year is about 2, 3, or 4 years, you are going to do what we call a present value adjustment. That is, you are going to determine the future payment into today's value. You understand what I'm saying now? Hello, answering me?
Yes, sir. Yes, sir. Yes, sir. Yes, sir. I'm hearing you, sir.
Yeah. But because the period for this question that we are looking at, the period is just within a year, there's no need to do all of those adjustments. Is it clear enough?
Yes, sir. But sir, can I read some sentence to you regarding to this contingent consideration?
Please go ahead.
I just want you to help. I didn't get it. They said IFRS 3 recommend that this should be fair value at the acquisition date. That is, the fair value should be used as purchase consideration at the year end. If the entity intends to pay by cash, this requires additional fair value. The closing fair value will be recognized as liability in the statement of the financial position, while the difference between the two fair value will be charged to consolidated retained earnings on the P&L account. However, if the entity intends to pay by issue of shares, this does not require closing fair value, where there is probability or uncertainty of meeting the condition. I don't get that sentence is very well, sir.
And what they are telling you is this. You know, this contingent, it can either be that you are using it for, you are paying cash, or you are using shares. You understand me now? So if it involves shares, you don't need to do any fair value adjustment. The fair value that I'm talking about here is, what will the interest be? What will be the additional cost? You understand me now? If you are telling me that, okay, you are buying my company today and you are going to pay me tomorrow, I will not wait now. I will not wait for that amount tomorrow. I will charge you something else on it. That's what we call the fair value of that contingent. Do you understand me now? The additional cost that the buyer will bear, you understand me, for delaying the payment. You get the additional cost that the buyer will bear if delaying the payment. That's what we refer to as the fair value. So that amount will be a liability to the buyer, and that's why you have to recognize it in the group retained earning to reduce the profit. Do you get it now? That delay now is substantial for your understanding. Now you say, okay, I'm buying your company this year, I will pay you next year. Me and the seller, for me to wait, there is something I must gain also. That gain, now I'm just saying it in a layman way that you will understand. Let's not use terminology that we're using, what you read. This is where I'm saying it now. Just carry it and interpret that thing. You will understand it much more better. But I'm saying that now, contingent can be that, okay, you are getting loan and then you are getting cash from the buyer, or you are taking loan and then you are using share, you are paying, you are using share in exchange for it. Do you understand? If it's a share exchange, you as a seller, you may not have control over it because even your own share may not be traded in the public space. Do you understand now? But me now as the buyer now, my own share may be traded, and since it's traded, I have much more value than your own. But if it is cash, you want to give me cash. That's why most of this contingent in the practical sense, in the practical world, most of this contingent consideration are always for cash, because those people that are also selling will want to make something. I'm talking in the practical life reality now, what we used to see on the field. Usually you will see that they prefer you do cash instead of share exchange, because there are risks that are involved with the share exchange. There are volatility in terms of risk. You don't know what is even going to happen in the future. You don't know whether the price of the share of the person that is buying you will crash below even your own value. So a lot of persons prefer to take cash. Is it clear enough?
Yes, thank you, sir. Thank you so much, sir.
Any other question in the next few seconds? No. Okay, in the absence of any other question, I think we can call it a day. Please, I need you to be reading. Ask me questions, ask me questions, ask me questions. The next class now, I want us to look at financial analysis, financial statement analysis there. Okay, if we have time, we'll also look at some other questions. Or if we don't have time, that means we're going to meet at the intensive class that is beginning this weekend. Or Friday, few seconds, just 1 second.
Sir, I just want to refresh your memory, sir, concerning the cash flow statement we did. The full video has not been uploaded. I don't know whether we will retake it.
Okay. We'll put it under advisement.
All right, sir. Thank you, sir.
All right. Thank you so much for your time. Have a very wonderful evening.
Thank you so much, sir. Bye.